The largest leverage engine in modern financial history is about to unwind. It moves trillions of dollars across the global economy in silence. And when it finally breaks, and it is breaking now, the system will have no choice but to reach for the one settlement asset that solves the exact problem the unwind creates. Welcome back. If you have not already, make sure you are subscribed and following, because this channel gives you the real crypto intel before it hits the mainstream. Right now, the macro conversation is reaching a pressure point, and some very sharp minds are starting to say out loud what the system has been quietly signaling for months. Jake Claver is one of them, and his message is simple but powerful. We may already be there. The idea is not that something speculative might happen someday. The idea is that the conditions for a violent liquidity event are already in place, and the timing window is narrowing fast. If the carry trade truly unwinds at scale, markets do not get a warning shot. They get repricing. This is not about hype. This is about mechanics. But this is the part almost nobody understands. To frame the macro backdrop properly, you have to understand Japan's role in the global liquidity machine for decades. Ultra-low interest rates allowed investors to borrow yen at near zero cost and deploy that capital into higher-yielding assets around the world: stocks, bonds, real estate, crypto. This was not a niche trade. This was one of the largest leverage engines in modern financial history. Trillions of dollars flowed through this mechanism, quietly supporting asset prices across the globe. But every carry trade has one fatal flaw. It only works as long as rates stay low. Once rates rise, the entire structure becomes unstable. Funding costs increase. FX risk reappears. Positions that were once safe become liabilities. And when that happens, the unwind is never orderly. Jake Claver's point is not that a small rate hike matters. A 25 basis point move is manageable. It creates friction, not collapse. But a 50 or 75 basis point hike changes everything. At that point, the unwind accelerates. Leverage must be reduced, positions must be closed, liquidity evaporates, and when liquidity disappears, correlations go to 1. That is why he suggests that if Japan moves aggressively, the real action does not wait for the next trading week. It can happen over a weekend. It can happen before markets have time to react. That is how carry trades die, and this is where the story becomes dangerous. Now let me be clear about something important. A carry trade unwind does not automatically mean XRP pumps the next day. These are two different mechanisms, but here is where the deeper connection emerges. When liquidity breaks, the system does not just sell assets, it looks for alternatives. It looks for mechanisms that allow value to move without forcing balance sheet stress. And this is where XRP exists for a reason. The current system forces institutions to warehouse capital everywhere. Nostro and Vostro accounts lock up trillions of dollars globally. That capital sits idle, earning nothing, waiting for transactions to clear. In a stable world, that inefficiency is tolerated. In a stressed world, it becomes dangerous. If Japan raises rates meaningfully, holding dollars in pre-funded accounts across the world becomes a balance sheet risk. FX exposure increases. Funding costs rise. Suddenly, the old system feels heavy. This is not an attack on the dollar. It is a structural problem with how the dollar is used. The question becomes whether the dollar can remain the global unit of exchange without being trapped everywhere at once. Now here's where things get serious. This is where XRP changes the equation. XRP does not replace the dollar. It changes how the dollar moves. Instead of pre-funding accounts across the globe, value is bridged at the moment of settlement. Dollars stay where they are. XRP handles the movement. Settlement occurs in seconds. FX exposure is minimized. Capital efficiency improves. Systemic risk is reduced. From a macro perspective, this actually supports dollar dominance. It allows the dollar to remain central without forcing institutions to absorb unnecessary risk. That is why XRP becomes more relevant during periods of stress, not less. Because once you understand what happens to global capital when the carry trade dies, you realize XRP is not waiting for a catalyst. It is the catalyst the system reaches for when the old machinery breaks. The asset that solves the friction problem becomes more valuable as the friction problem becomes more painful. And the carry trade unwind is the event that makes the friction problem unbearable for the institutions that are currently absorbing it, and what happens next changes everything. Now layer this macro pressure on top of what Ripple is building operationally, because the institutional positioning is not theoretical anymore, it is documented. Ripple is no longer just a payments company, it is becoming a full-stack liquidity and settlement provider for institutions. Hidden Road gives them prime brokerage capabilities. Ripple Prime consolidates treasury, custody, and execution. RLUSD adds a native on-chain dollar representation. Combine that with XRP liquidity, and you have something far more powerful than a retail exchange. This is not Coinbase. Coinbase serves retail, Ripple serves institutions, and institutions care about one thing above all else: balance sheet efficiency. Imagine trillions of dollars currently trapped in idle accounts suddenly earning yield, not speculative yield, real yield from settlement, liquidity provision, and operational use. Even 1% on trillions is enormous. 2 or 3% changes corporate finance entirely. This is why institutions do not walk toward this technology. They run. The reason they have not before is simple: regulatory uncertainty. That is changing. Stablecoin frameworks are being formalized. Regulatory parameters are being drawn. The Clarity Act is approaching. Rulemaking is aligning. This is not theoretical anymore, but this is the part almost nobody is connecting. At the same time, tokenization is moving from concept to execution. Wall Street is no longer debating whether assets will be tokenized. The debate is about how fast and who controls the rails. The largest asset managers on the planet are already involved. Treasuries are being tokenized. Money market funds are on chain. Bonds are moving first because they are the most liquid. This follows a very predictable pattern. You do not start with illiquid art or collectibles. You start where the money is: dollars, treasuries, bonds, equities. And once those assets move on chain, settlement speed, capital efficiency, and transparency improve dramatically. This is not about crypto ideology. It is about upgrading outdated financial plumbing. When regulators give clearinghouses the green light to tokenize, it sends a signal to the entire industry. This is happening. Legacy rails will not disappear overnight, but they will be phased out. Liquidity will not be split forever. It will converge. And public blockchains will be part of that convergence because they provide neutrality, liquidity, and interoperability. This is where assets like XRP fit. Private blockchains may handle internal records, but they still need to connect to public liquidity. Value has to move. That movement requires a neutral bridge. Now here's where things get serious for the bridge function. Let me slow down on that point because it is the structural insight that the surface level coverage of this transition keeps missing. Tokenization is going to happen on multiple platforms. JP Morgan will have its own chain. Citigroup will have its own infrastructure. BlackRock will use its own architecture. The DTCC has Project ION. There will be dozens of private and semi-private chains operating in parallel, but those chains need to settle value between each other. They need a neutral bridge that does not belong to any single institution. That bridge cannot be JP Morgan's chain because Citigroup will not accept it. It cannot be BlackRock's infrastructure because Vanguard will not accept it. It cannot be a Federal Reserve product because non-US institutions will not accept it. It has to be neutral. It has to be globally accessible. It has to be operationally proven, and it has to be regulatorily compliant across multiple jurisdictions simultaneously. The XRP ledger is the only major public blockchain that meets every one of those criteria right now. That is not a marketing claim. That is the structural read on what tokenization actually requires. And this is where the story becomes dangerous to dismiss. Now let me bring this back to price without getting emotional. Short-term price explosions are possible in stressed environments. Liquidity events can cause violent moves. But the real story is not whether XRP moves this weekend or next week. The real story is that XRP is being positioned as infrastructure at the exact moment the old system is under pressure. Infrastructure assets do not behave like speculative tokens. They do not rely on narratives. They rely on necessity. And necessity emerges during stress. If Japan's carry trade unwind accelerates, the system will look for tools that reduce friction. XRP is one of those tools. That does not mean instant adoption. It means relevance increases when it matters most. Zooming out even further, ETFs, institutional accumulation, and regulatory clarity all reinforce the same theme. Demand is increasing. Supply is being absorbed. OTC desks are seeing consistent buying. At some point, liquidity tightens. When that happens, price discovery changes. Not because of hype, because of structure. This is not about guessing dates. It is about understanding phases. We are not in a mania phase. We are in a transition phase. The pipes are being laid. The valves are being tested. The system is preparing for flows that most people are not watching yet. Now here's where things get serious for the timing window. Jake Claver may be right about timing, or the move may take longer than the carry trade unwind window he is describing, but the direction is not random. Macro pressure, liquidity stress, infrastructure build-out, regulatory alignment. These forces do not reverse easily. They compound. And that is why moments like this matter. Not because of excitement, because of positioning. Those who understand structure do not panic if Monday is quiet. They understand that silence often means preparation. Financial systems rarely scream before they move. They whisper, and right now, the whispers are getting louder. The institutional players are not waiting for the headlines to confirm what their internal models are already telling them. They are positioning through the silence. They are accumulating through the consolidation. They are deploying capital into the assets that solve the problems they know the next macro event will surface. The retail community is watching the chart and asking why nothing is happening. The institutional community is watching the machinery and adjusting their positioning to be ready for when the machinery breaks. Two different time horizons, two different frameworks, two different outcomes when the catalyst actually fires. And what happens next changes everything for the carry trade window. As we move into the broader implications, it is important to separate emotional expectations from structural reality. Markets are conditioned to chase immediacy. Social media amplifies urgency. Everyone wants the move now, but real capital does not operate on impatience. It operates on readiness. Carry trade unwinds are not one-day events. They are processes. Sometimes they spike violently, sometimes they grind, but once they begin, they rarely stop cleanly. Japan's situation is not isolated. It intersects with global debt, aging demographics, the limits of monetary policy. The Bank of Japan is boxed in, and every move they make has global consequences. This is why macro desks are watching closely. But here is the key insight. Even if the unwind is gradual, it still forces the system to adapt. Capital efficiency becomes paramount. Idle balances become unacceptable. Settlement speed becomes strategic. That is the environment where XRP thrives. A violent unwind produces a violent repricing. A gradual unwind produces a sustained migration toward the infrastructure that solves the problem. Either way, the destination is the same. The variable is the speed of the journey. But this is the part almost nobody is sitting with. Now layer in tokenization again. Once assets move on chain, settlement becomes atomic. Delivery versus payment happens instantly. Intermediaries are removed. Capital is freed. That capital does not sit still. It seeks yield. This is where the conversation around yield becomes critical. Yield does not have to come from staking or speculation. It comes from use, liquidity provision, market making, settlement facilitation. These are not crypto-native ideas. These are core financial activities that have existed for centuries. Blockchain simply makes them more efficient. When XRP becomes an operational asset, it is held to be used, not sold. That changes supply dynamics. It reduces constant sale pressure. It creates inventory demand. It stabilizes markets. This is what institutions want. Price appreciation then becomes a secondary effect, not the goal. The primary effect is operational utility. The price appreciation follows naturally from the reduced selling pressure and the increased inventory demand. The institutions are not chasing the price. They are positioning for the utility, and the price is the consequence of the positioning, not the motivation for it. Now, here's where things get serious for what kind of asset XRP becomes. The most important takeaway is this: XRP is not waiting for permission from retail sentiment. It is being pulled forward by institutional necessity. That is a very different driver. Whether the catalyst is Japan, regulation, tokenization, or liquidity stress, the direction remains consistent. The financial system is upgrading its plumbing. Assets that become part of that plumbing are no longer optional, they become required. And required assets eventually reprice, not because of hype, but because demand has no alternative. This is not about predicting a happy Monday. This is about recognizing that we are in the middle of a structural handoff. From old rails to new rails, from trapped capital to mobile capital, from inefficiency to optimization. XRP sits squarely in that transition. That is why moments like this deserve attention even when price is quiet, especially when price is quiet, because silence in markets often precedes movement. And understanding why that movement happens is how you stay ahead of it. And this is where the story becomes dangerous to underestimate. Let me bring in one more layer. The institutional positioning around XRP is not happening in isolation. It is happening in parallel with similar positioning across the broader infrastructure of tokenized finance. The largest asset managers are building tokenized treasury products. The largest custody banks are launching tokenized money market funds. The DTCC is moving toward T+0 settlement. The Federal Reserve is preparing for a streamlined master account framework. The OCC has already granted Ripple a conditional national trust bank charter. Each one of those developments is independent. Together, they form the institutional architecture that requires a neutral settlement asset to function at scale. And the neutral settlement asset all of these developments are converging on is XRP. The institutional players are positioned. Their positioning is documented in the on-chain data. The the whale accumulation, the exchange balance compression, the ETF custody growth, the institutional credit facilities, the cross-jurisdictional regulatory approvals, the corporate partnership announcements landing in clustered waves rather than isolated headlines. All of that is happening underneath the chart. The chart will eventually reflect what is happening underneath it, but the chart is the lagging indicator. The leading indicator is the institutional positioning, and the leading indicator is moving in one direction. Now, here's where things get serious for the dollar's role. Let me address a question that comes up every time this thesis is discussed. If XRP becomes the bridge asset for global settlement, does that mean the dollar loses its position as the global reserve currency? The answer is the opposite. XRP supports dollar dominance by removing the friction that makes the dollar's global role increasingly difficult to maintain. Right now, the dollar's usability is constrained by the cost of pre-funding accounts across every major economy on Earth. That cost is going up as interest rates stay elevated. As the carry trade unwinds, the cost goes up further. At some point, the cost of using the dollar in the current architecture exceeds the benefit. XRP fixes that. The dollar stays central. The XRP bridge handles the movement. Dollars stay at the Federal Reserve. Pre-funding requirements collapse. Capital efficiency improves dramatically. The dollar's role is preserved without forcing institutions to absorb the increasing cost of the legacy architecture. That is why the Trump administration's strategic reserve named XRP alongside Bitcoin, Ethereum, Solana, and Cardano. That is why the OCC granted Ripple the conditional trust bank charter. That is why the Federal Reserve is creating the streamlined master account framework that specifically benefits Ripple's positioning. The administration is not undermining the dollar by supporting XRP. They are protecting the dollar by supporting the infrastructure that allows the dollar to keep functioning at global scale, and what happens next changes everything for the supply dynamics. The supply side of this equation is where the math gets interesting. Exchange balances are at the lowest level since 2018. ETF custody is growing every week. Whale wallets accumulated 1.15 billion XRP in April alone while retail was selling. The institutional credit facilities being deployed by Ripple Prime are creating additional structural demand for XRP as collateral. The corporate treasury platform being deployed by Ripple Treasury is creating demand for XRP as an operational holding on Fortune 500 balance sheets. Stack that demand growth against the supply that is actually available to absorb it. The escrow releases from Ripple are declining as more of the released supply gets absorbed through OTC channels invisible to public markets. The active circulating supply available on public exchanges is shrinking. The dormant supply held by long-term holders at the $2 cost basis is unavailable until prices approach that level. When you put institutional demand growth on top of structural supply compression, the math produces the kind of supply shock that previous cycles have only hinted at. A 25 times liquidity multiplier on $600 billion in inflows produces $255 per XRP. A 50 times multiplier produces $500. A 100 times multiplier produces $1,000. The variable is not whether the dynamic plays out. The variable is what the multiplier ends up being. And the multiplier depends on how compressed the supply is at the moment the inflows hit. The supply right now is the most compressed it has been in this asset's history, but this is the part almost nobody is internalizing. The carry trade unwind in Japan is not the only catalyst that produces this dynamic. It is one of several catalysts that converge in the same window. The Clarity Act passing into law, the Federal Reserve streamlined master account framework activating, the first major U.S. bank announcing XRP integration under Section 401 authorization, the first DTCC tokenized settlement that routes through XRP rails, the first sovereign wealth fund that publicly allocates to XRP. Each one of those events is in front of us on a defined timeline. Some are calendared, some are probabilistic, but all of them are moving in the same direction, and the direction compounds. If you are a holder watching the price chart during this exact window and feeling like the market is not reflecting what you are reading about, that disconnect is the structural opportunity. It is the gap between what is being built and what is being priced. The gap closes when the institutional positioning becomes public, and the closing of the gap is the move that the patient holders have been positioning for since the consolidation began. And this is where the story becomes dangerous to oversimplify. The macro pressure that Jake Claver is describing, the Japan carry trade unwind, the global liquidity stress, the Bank of Japan being boxed in by demographics and debt, is not the kind of pressure that resolves cleanly. It builds, it compresses, it creates moments of acute stress that the system tries to manage. and eventually it produces the kind of repricing that catches the surface-level observers completely off guard. The institutional players are not surprised when these moments arrive. They are positioned in advance. They build their portfolios with the assumption that the macro stress will eventually surface, and they position their capital into the infrastructure that benefits when the stress finally breaks. XRP is that infrastructure, not because of marketing, because of the structural function the asset performs in the system being built around it. The carry trade unwind is one of the macro catalysts that surfaces the demand for that infrastructure. The Clarity Act is the legal catalyst. The Federal Reserve Framework is the regulatory catalyst. The tokenization build-out is the operational catalyst. The institutional positioning is the demand-side catalyst. All of those catalysts are converging on the same window. Now here's where things get serious for what to watch next. What I am watching specifically over the next 60 days is the macro stress indicators in Japan. The Bank of Japan's policy meetings, the Japanese 10-year yield, the dollar-yen exchange rate, any sign of accelerating rate adjustments, any sign of forced position unwinds in the yen-denominated leverage products that the carry trade depends on. I am watching the Clarity Act progression, the Senate floor vote schedule, the reconciliation process between the Senate and House versions, the presidential signature timeline, the 360-day implementation window that follows signature. I am watching the Federal Reserve transition, Kevin Warsh's first 90 days as chairman, his messaging on rate policy, his coordination with the Treasury under Secretary Bessent, his positioning on the streamlined master account framework, and I am watching the institutional positioning data, the ETF inflows, the whale wallet movements, the exchange balance compression, the OTC desk activity, the cross-jurisdictional regulatory approvals that continue to land in parallel. Each one of those data points moves the probability weighting on the convergence. Each one of them informs the positioning decisions that the patient holder is making during this exact window, and what happens next changes everything for the next phase. The system is preparing for flows that most people are not watching yet. The macro stress is building. The institutional infrastructure is being deployed. The regulatory framework is being completed. The tokenization wave is starting. The carry trade window is narrowing. The patient holder is positioned. The institutional players are positioned. The chart is the lagging indicator. We may already be there. Jake Claver's framing is correct. The conditions for the violent liquidity event are in place. The timing window is narrowing. The mechanics are visible to anyone who knows where to look. And the response of the system to that liquidity event is going to require infrastructure that solves the exact problem the unwind creates. That infrastructure is XRP, not because of marketing, because of necessity. Markets don't scream before they move, they whisper. And the whispers right now are not coming from the chart. They are coming from the machinery underneath it. And the machinery is shifting faster than the people watching the surface can hear. If you found value in today's breakdown, hit the like button, subscribe to the channel, leave a comment below with what stood out to you most, and share this with someone in your circle who is still watching the surface while the machinery is being rebuilt underneath it. Subscribe and hit the bell, because when the Bank of Japan makes its next major policy move, when the Clarity Act reaches the Senate floor, when Kevin Warsh's first Fed statement lands, when the streamlined master account framework activates, and when the first major institutional XRP partnership becomes public, my breakdown is live within hours of each event.